Hi, everyone, and welcome back to another show. My name is Tyler, and I'm here with Matt, the founder of ORATS. ORATS is an options analytics platform built on top of over 15 years of historical options data. And our dashboard is integrated with Tradier, meaning you can research and discover trades on our platform and then seamlessly send them through to your brokerage account. Last week on the show, we traded a double calendar spread on UPS. Today, we'll review how that trade went and then dive into some of our earnings calculations that we do here at ORATS. Matt, if you're ready, do you want to share your screen and go over the trade from last week?
Let's do it. Turn my drawing tool. All right. So this is the trade that we did in UPS. Sorry, I had to take a picture of it from the YouTube. But so we did a double calendar, the 150 puts and the 165 calls. UPS went down, and so it was at 156, and so we did it for $2. So let's look at what happened to that. So we have our trade history. So this is the trade history tool here, and this is the you could put together. I just put together this trade. So selling the 165, buying the 165, selling the 150 put, and buying the 150 put. So we put it on, back here for $2, and then when earnings came out, it immediately popped up to 4, and then it was looking pretty good, and so I was should have got out here, but I let it go. The stock went down, kept going down, and then so to where when the front month came off, it was at $1.70. So it's a small loss. So what I had happen is I just closed out the front two. So the front two, so the February. So let me see if I could X that one out and X that one out. 8 to today's date. Let's see what happens there. Yeah, it seemed to work. So so right now, the one. So what we're only concerned really with the 150s, and so they so that went out at $8, and let's see here. And so so we ended up long a put. So what I like about these calendars, double calendars, is that we're able to, if you let the front month cancel, then you're just plain long the straddle for often a much cheaper price than you got in for. So the bottom line is that we thought we were going to be down, but we're actually up because UPS is down right now. So let's type in UPS.
Maybe try opening it in a new tab, just the dashboard. Yeah.
I think when my login conks out, then I have to go in this way. I have to find my login.
Did it expire?
Yeah.
Okay. That's fine.
So you have to keep
timing for that, huh?
Yeah, of course. So you have to keep your login going. So anyway, so we looks like we're going to get out for a couple dollar profit right here. So I think today, Tyler, that's the last trade that we have going on right now. So I think today, what's our talking points now?
Well, we wanted to go over a lot of the earnings tools that we have in our dashboard. So we have the sort of the earnings analyzer where you can see the range, the implied range versus the actual move for the last 12 earnings reports. So this goes back a few years, and you're able to see sort of, was a long straddle profitable or was a short straddle profitable?
Okay.
And that's sort of, the simple things, but we do a lot of calculations on X earnings volatility, and isolating the earnings effect and all these things that help you sort of figure out, resolve all the confusion around earnings, and we boil it down to a bunch of indicators that we calculate.
Right.
So if you want to pull up the earnings tab.
Yeah. So what I'd like to do is, before we get into that, I'd like to show how we do a lot of these calculations. So I want to talk about earnings, and how, even before we get into the specific tabs, how we do a lot of these calculations. So this is the Excel the Excel interface to our API. And what I could do here is just type in a symbol, and I could I want to go to implied money. So I want to talk about, let's just see, Apple. Let's see here. If we could get something going here. So what I'd like to do here is show how we come up with our X earnings calculations. So here's Apple, and what we do is we have this earnings effect column, and so the earnings effect column hangs out. It goes. There are numbers in it. The expiration after or on the earnings date. So for Apple, it's sometime between April and May. And so what we do is we go in and we try to figure out, okay, so we could see that there's a bump up here. So for example, color these. We see that there's a big bump in May. So that corresponds with the earnings effect that we have. So your question might be, well, okay, so obviously it's 19, 18, and then 20. So there's something going on there. And so what our goal is to say, well, what would the volatility be if there were not earnings on that date? And then so we have to do something that's called drawing a rational skew. So we draw a rational skew through these points and come up with a term structure. It's called term, meaning instead of strike by strike, it's month by month, and then a term structure curve. So it has to be a smooth curve. We call it a rational smooth curve. So we've drawn this skew here, which is what we call a rational curve through there. And I'll just format it so we can see it a little bit better. And so this is what we think Apple would be if you were to take out all of these earnings effects. And some of these have multiple earnings in there, and our calculation accounts for that. So this is the additional amount of volatility that is in these. So we would say that it's about in May, about a 19.3 volatility in May. And then so when we communicate what's the X earnings volatility, we don't say 20.3, we say 19.3, a full 1.3 volatility points below what we're calculating on the unadjusted skew, as we would call it. So this is important because then we could come up with things like X earnings volatility at each point, and then those are comparable throughout the. Those are comparable over time, and so because what happens with volatility is it red. So if implied volatility is here and time is here, and then these are earnings dates. What tends to happen is that the implied volatility will drift up to the earnings date and then crash down, and then you drift up to the earnings date, crash down, drift to the earnings date, crash down. So if you want to get some sense of what the true volatility is, it's very difficult if you have earnings still baked into your the volatility. So what we do is we take it out, and then so then we might say, okay, so then X earnings might look like this, and you say, okay, well here was the highest point. Actually, it would be below, but it might not look like that if you were if you weren't taking earnings out of it. So that's the main reason that we do this business, is to have a comparable implied volatility, and then also to start to measure what the market's additional implied volatility is, and so you could say, what is the implied earnings amount for these particular for this particular option. Does that make sense, Tyler?
Yeah, that was a very good overview of the calculations. I wanted to describe a little bit like why we do this, and you mentioned it a little bit. It's mainly so that we can compare sort of apples to apples, right? Like we're taking the volatility from here, and we can compare it to other symbols, like related equities, and we can talk about the underscore C symbols that we have, the best ETFs, right? And then you can also compare it to history too. So using these, sort of X earnings volatilities allows us to compare them to history and to related equities to sort of derive, some sort of effect from it.
Right. Yeah, good point. So this is the monies. I should say that this is the implied monies endpoint. The implied monies endpoint is an expiration by expiration endpoint. So we have three different types of endpoints. So we have a strikes endpoint, and when you go get our strikes data from our API, what we do is we have a 1 row per option. And I should also mention that we have 1 row per option, and we have both calls and puts on the same row. And we get this question a lot. They go, well, isn't the delta, gamma, theta, aren't the Greeks different for calls and puts? And the answer is they can be, but for 99% of cases, the Greeks should be the same for calls and puts. So let's just talk about that for a moment, because I think that's, besides the X earnings, I think that's one of the most important parts of our data is what we do to ensure that the call and puts line up. Now, put call parity is a rule that applies to the formula, the Black-Scholes formula. And what that says is it says that the calls and puts should be in parity, and the only difference is going to be the only difference between the calls and puts, should be like if there's a dividend or something along those lines. So what? Why don't I go through exactly how we kind of calculate that? So how do we ensure that put call parity exists? So let's go back to the implied monies. I think that's the easiest way. And let's talk about implied monies. I'll take out this color here. So the first thing that we do when we're coming up with we call it our SMV, our smooth market volatilities. So first thing that we do is we calculate implied volatilities for the bid and asks of all of the options. and with our assumptions. So we have a very good dividend feed. We sell it to various exchanges and hedge funds and stuff. So that's the first thing, is that we get a very good dividend. So that's our yield rate here. So that's actually what the dividend means. And so the second thing we have, of course, the risk-free rate. We use treasuries. So right now that it's kind of interesting. The treasuries are expecting cuts from the Fed. So as you go out in time, they're in a backwardation, as we call them, but the front month is higher than the back month. So we see risk-free rates and we see yield rates. So both of those things, you have to have those correct, or the calls and puts won't line up. You have to have those, when I say correct, you have to have those in line with what the market thinks. So if the market is expecting a larger dividend, you're going to have a different assumption, and the calls and puts might have different implied volatilities, and then that throws off the Greeks, because what drives the Greeks, Vega, Theta, even Delta. Delta of a put is the call delta -1, but the Vega and Gamma, Theta are the same if put call parity is holding. So a lot of times we'll get comments from our clients saying, "Hey, in my broker, I see the Theta is much different, or the Gamma is much different." And I said, "Well, are the implied volatilities equal on the calls and the puts?" And they say, "No, the calls are much higher." I said, "Well, that should never be the case. You should never have more premium in calls than the puts, because there's an arbitrage there that can be put on." So the trick is, and a lot of people don't do this, is you need to then figure out where you're wrong, or more accurately, where you're different from the market in the interest rate that's assumed in the market. So what we have a process called calculating the residual yield rate. And what the residual yield rate does is by applying the residual yield, it will line up the call and put implied volatilities by adjusting, either for a risk-free rate that might be off, because that's changing a lot, especially now, or a yield rate that might be changing. So what we do is each month we solve for a risk-free rate. And we also, just to get a little bit more nerdy, we also slope, or put a slope in there, because sometimes the lower strikes have a different implied interest rates than the higher strikes. So anyway, so back to what we're doing is we're trying to line up the calls and the puts. So what you want is almost an exact match between the calls and puts by adjusting the underlying yields, which consider dividends, and of course we use discrete dividends, so we know the actual feed, and we're using a modified binomial model. So in that modified binomial model, it accounts for early exercise. So we're getting a little deep, but that's kind of where you need to go to figure this out.
That's great. Can you tell us what like a positive residual yield rate means versus like a negative?
Yeah. So the way I think about it is you need to add the residual yield to the yield rate. So the funny thing about the rates is the interest rates works differently than the yield rate. So they're opposite. So if you have a positive yield rate, that means your dividend needs to be higher. Or conversely, your risk-free rate needs to be lower. Does that make sense? So that's the way to think about it.
Okay.
So yeah, so let me just go through the entire process, the entire SMB process, because this is important. What we do to come up with what we think are the best Greeks and summarizations in the industry. So basically what we do. So now the first thing we do is calculate implied volatilities. Second thing that we do is we come in and we solve for the residual rate. Then we go back and calculate implied volatilities again. So now these are the implied volatilities that line up the calls and the puts. And it's, if there's a slope to it, it takes that into account. So the cool thing is now we have a bunch of options, bid and ask implied volatilities that line up with each other. So we have twice as much data to use as if you were just creating a skew out of the calls separately from the puts. So we combine those and we draw lines and we weight because we weight the out of the money calls higher than the in the money puts for those strikes, and we weight the out of the money puts higher than the in the money calls. And the reason that we do that is there's a lot more liquidity out of the money. That's where most of the trading happens. In the money means has intrinsic value, and if you trade those, there's a lot more delta, there's a lot more risk. So the markets tend to be wider, and I was a market maker. Market makers tend to lean towards the deltas that they need. So if they need to get longer, there'll be more bid on the in the money call option. So that's just neither here nor there. But we weight the out of the monies more when we're now trying to draw a curve through these different strikes, because as you know the typically the let me get red. The smile that exists. So if this is the at the money, these are the low strikes, and this is the high strikes, and this is implied volatility over here. Typically you'll see a skew that looks like that. And so so what we need to do, and then there'll be implied volatilities all around here, but we want to find a rational way to draw this skew. And it's super important, and I want to get this across to people that the importance of this comes in first, it creates a theoretical value. So so you probably wouldn't want to sell this call because it's too low, and versus its neighbors. So that's one thing. The other thing is, if it's a very wide market, so the bid and ask might be here and here, you want to create a good reference point to be able to calculate Greeks off of. So this line then becomes your point that you are starting to calculate your Greeks. So now this gets back to, hey, why am I, when we get comments from people, we get comments between the calls and the puts, but sometimes we get out of the money puts, way out of the money puts. The market might be, no bid at $2. So the no bid doesn't have any implied volatility. The $2 might be 100% implied volatility. When in fact, if you draw that skew through it, it might be just a 33 vol that has a value of a call of a put that's 2 cents or something, not $1 or $2, whatever it would be at the midpoint of that extremely wide market. So then when you calculate the implied volatility for that, it's much more rational. You wouldn't put a 200 or a 50 or extremely high implied volatility on that. So does that make sense, Tyler? I want to get across that by smoothing the way that we do, we create good Greeks and we create good theoretical values.
Yeah. And it really boils down to three things we look at, right? The interest rate assumptions that you mentioned, the dividend assumptions, and then liquidity, which is also really important. So if we take all those considerations into account, we can smooth it. So instead of drawing that line between the calls and then the puts and then having different Greeks for each one, we're drawing one sort of in between that's smooth. And yeah, and that's why you're, like you've mentioned, you're seeing one value for all the Greeks that we offer instead of a call and a put. And when you're looking at a skew chart, like if you're looking at the skew, a lot of people just draw it either at the call or the put skew, and they call it the call skew or the put skew. We just have one skew that we draw, and that makes it easier to analyze a lot of things.
Right. And yeah, good point. I neglected to say, so, there are these dots, we draw the line through the dots, but then we say, okay, so the first thing is we get good Greeks from this. The second thing is, we have good theoretical values. So when we're trading, we are thinking about, is the trade that we're sending to the market, it might be mid-market, but is it really good versus the S&P? So you have another kind of way to look at things, and so that's very that's very important. And the third thing is, when you get a smooth skew like this, you could look at slope derivative, which is basically what we use for summarizing the vol surface. So let's talk about that for a second. So what we do then is we draw a line through a tangent line, and then at the 50 delta, so whatever, about right there. And then so every 10 vol points, we might say it's 5% different. Meaning if you have 100 IV here at the money, the 50 delta, the 60 delta would be 105. Okay, and then so that's a 5% slope, and then the derivative is just how much the slope increases as you go away from 50 delta every 10 delta. So that might be 1%. So this might be 5%. This might be 6% steep. This might be 7% steep. The reason it's changing is the derivative. What's changing is the slope. And then what that slope does is it defines the relationship between the different strikes. And it's important to use delta and not anything else, because delta will move with implied volatility. If you're using like percentage or something like that, you're not going to get consistency. So we found over the years that when we're calculating slope, when we're calculating the skew, it's important to use delta. So you want to use delta on your x-axis there. Does that make sense, Tyler?
Does, yeah. And going back to sort of the overarching theme of earnings, right? Like, this is sort of what we have to do, all these calculations with the S&V process before earnings. And that's how we take out the earnings effect, right? That we're just building up to that point of eventually taking out the earnings effect, because we want to have a really accurate volatility surface in order to do that.
Very good point, and I'm remiss. So that we find a very good at the money volatility, and in order to get really, really precise on this, you need to find that really good implied volatility. And the way that we do that is by drawing the skew, and then rising all these up, but finding that point at the 50 delta. By the way, this vol 100, that's 100 delta. This fall 75, this is popular. 75 delta call, 25 delta put. So these are all the volatilities at that point, at those points on the skew. So this might be the 70 right here. The 100 might be up here. So that's why these are often much higher. But yeah, you bring up a good point. In order to get accurate earnings, implied earnings moves, you need to have very accurate at the money volatilities. So that's what I kind of wanted to show today, Tyler. So we got into our endpoint and how ORATS really works hard to line up the call implied volatility with the put implied volatility. And why do we do that? Then we have a lot of points to use, and we can create this curve that we draw through, much more accurate, many more points to use. And then we could come up with a much more implied volatility. We could summarize all this stuff with slope and derivative, and then take the earnings amount out. So we have an implied volatility X earnings. And now we have something that we could look at over time and really make some good assertions, like, is the vol high right now? Is the slope high right now? But all this has a lot to do. And you're right, like individual stocks that have earnings just, it's one more step that you need to get to, but you really need to start with lining up, because the call and put implied volatility should line up no matter if you have earnings or not. That just has to do with the rates that you have, making sure that your rates are there. I should also say, if it's a hard to borrow, and let's just talk about that for real quick. So if there's a hard to borrow, these numbers will be very high, because what happens is when a stock is hard to borrow, instead of getting money when you're short the stock, you have to actually pay money to locate and borrow those dear shares from other people. Because what's happened is, a lot of people think a stock's going down. They say, "Can I short it?" They go, "Yeah, we'll have to find the shares from someone, has to loan it to you." It's all kind of a weird back room thing that's done at these brokerages, but they borrow it, and when more and more people are borrowing, then you usually get paid if you're short stock. But if you're short or hard to borrow, you're paying money to do that, and what will happen is this residual yield will be positive, and we'll identify certain stocks as hard to borrow, and you'll see what the rate is in the market that's being implied, how much you have to pay in order to short this particular stock. So that's another big thing, and one of the offshoots of this whole SMB process that includes coming up with earnings moves and the ability to identify how much we believe is cooked into a stock at implied volatility levels for certain expirations. So so I think that's what we've gone through today, and I think this is this is kind of it's more boring than finding a trade. It's more boring than that, but you have to be very confident in what we call the fundamental blocking and tackling of options trading, and this is really that. And ORATS, this is one of the reasons we developed ORATS is so we can, we have the skill to do this. When I was market maker and backing market makers, all these little numbers were super important, and we'd want to know each one, and we'd want to know which ones to trade off of. And so we're able now to automate this. This runs all through the day and is updating. So if these residual rates are changing, we're seeing them. If the implied earnings moves are changing, we're seeing them. And in the signal builder and some other places, you could actually see that you graph them minute by minute basis, and you could graph them historically. So that's another really cool thing, is all this data is shown historically, and it's one of the reasons that we work so hard to normalize and make it so it's comparable both historically and between stocks. So yeah, I think it was a good show, Tyler.
Thanks, Matt. Very important to understand those indicators so you can put them to good use in our scanners and tools like that. So yeah, if you guys have any questions on our indicators, if you need something clarified or wondering where to find it or anything like that, leave a comment. We always look at those, and then chances are we'll cover it in the next show. So yeah, thank you for watching, and we'll see you guys again next week.
Thanks, Tyler. Thanks, Trader.
Bye.